So if you've been clueless around your Forex friends concerning the terms they throw around, or you're new to Forex and you don't understand some of these terms you hear on YouTube videos talking about Forex trading, and in this video we'll break down the basic terms or terminologies that you need to know in Forex trading and the ones that you actually can't survive without knowing or how to deal with them. The first one is a PIP. So what is a PIP? A PIP is actually an abbreviation to mean price, interest point, percentage in price, and basically it means this is the measure of change in price of a currency pair. So for instance, if you're trading Euro USD and the price is 1.0773, then that price changes to 1.0774, then that change has been 1 pip. Essentially, it is always the fourth decimal point in most of the pairs, and the yen pairs, which is up to 2 decimal points, is only the second decimal point. When you look at the charts, different brokers will have a 5th decimal place, or you might see on your terminal, you might see another number, the 5th one written slightly above the 4th decimal number. That is a 10th of a pip, and we call it a pipette. Now the next one is a lot. A lot is actually the size of your trade. If you're taking a position in the market, say for instance you're buying Euro USD, so you're buying from 1.0773 and you are willing to take profit when your price reaches 1.077 say 8. So you're taking there a small 5 pips of profit. Now, the amount of money you make at the end is determined by the size that you take, the risk that you put into that trade. So for the same 5 pips, another person would make say 5 cents, 50 cents, another would make $5, another would make $50, another would make $500. So the difference is mainly based on the sizes. So that's what a lot is. A lot is the size of the position that you're taking in the market, and it's a function of the distance the price moves by value per move, essentially value per pip. So it's a bit of calculations here and there. I will not bore you with the various calculations to determine lot size when you're trading, but there are several apps and indicators that people use to actually determine the lot sizes that they're willing to take, because that lot size will also determine the kind of risk. When you lose the money, how much are you going to lose? So you need to know so that you are able to trade the appropriate lot size, and it is also determined by the account size. If your account size is small, then you trade a smaller lot size. If you have a bigger account size, then you are free to trade a bigger lot size without affecting your account so much. So instead of going into the mathematics and calculations how you come up with the lot sizes or how to calculate the value per pip, then the best thing would be to just download the very many tools that allow you to calculate lot sizes. So if you go to my FX book, I think you can get a position size calculator. If you go to Baby Pips, there's a position size calculator. If you go to Investopedia, Bloomberg, and several other indicators that you can use. If you're interested to know which one I use for my calculations, then comment below so that we do a video just showing how you can use this free tool for calculation of your lot sizes. Yes, so up to a bit more simpler ones, short and long. So when someone says they are short or long in the market, what do they mean? So if you're short, it means you are selling. If you're long, it means you are buying. This also can be used interchangeably with bullish and bearish. So if you're bull in the selling market, it means you are buying in that market. So if you're buying, you can say you are bullish in the pair, say you are bullish on Euro USD, or you can also actually say that you are long on that pair. Where the bear and the bulls came from, I think it's historical, and I don't have the facts. So if you know some factual things in the history that made them choose a bull to mean buying and bear to mean a falling market, comment below so that we can also learn from you. The fourth one is candlesticks. What are candlesticks? If you've looked at the Forex charts and maybe you are surprised or you are overwhelmed by the charts that you see, there's a high chance that you've seen a candlestick chart. So candlesticks, in fact, these things came before even started bar charting in Forex trading. They, in fact, 100 years before bar charting began. and this one was discovered by a man in Japanese, such as Bitcoin again. So this guy called Homan discovered candlesticks, and the main thing behind candlesticks is that he noticed that price of wheat was not moving purely based on supply and demand. So he noticed that when people are buying wheat, it was not because the demand was high or that the supply was limited, but he noticed that an effect of or influence of emotions. So notice that emotions also influence people's buying of a certain commodity or buying of, for us now, currency. So when you look at the candlesticks, they are actually influenced by people's emotions. So before we proceed, guys, it's a worrying statistics that just slightly below 30% of those who watch our videos are subscribed to the channel. And if you like what we keep putting into this channel, kindly take a moment. It takes only maybe less than a minute to subscribe, to like, to share with your friends, and hit up the bell so that when we post new videos you can be notified. So back to what we're talking about. So a candlestick has 4 parts. There's a high, there's a low, there's an open, and the closing price. So, and there are 2 types of candlesticks. So you either have a buy candle, that's a bullish candle, and you have a bear candle, that is a short candle. So we start with a bullish candle. So a bullish candle is a candle that denotes buying pressure. So it will open lower than it closes, so the price opens lower. Then it might move lower to give you a low. Then it will expand upwards to give you the high, and then trace slightly down to give you the close. For a bullish candle, the open is lower than the close, and then you have a wick down and a wick up. So the highs and the lows, they form the wicks. For a bear candle, this is a selling candle, which will denote selling pressure. It opens above the close, so it opens higher, then makes a high, comes down, makes a low, and then closes. It can close near the low or away from the low, but it's a bear candle. So most of the time you'll find it colored differently in different charts, which again is within your own powers to choose the kind of colors that you want to color your candles with. The importance of candlesticks, not just for us to see and know which one is a bear and which one is a bullish candle, but we also have candlestick patterns that actually give us data to make decisions on whether we enter or exit a trade. To go to candlestick patterns that I use for my entries and exits, and that give me more information in the market. Finally, let's talk about equity. So when you open your Forex traders terminal, you'll see that when you trade, there's a balance, there's equity, there's margin, and you have the profit and loss. So equity actually is the sum of your profit and loss and the balance. So when your trade is open, always the balance is always static. So, but when a trade is open, your equity will be fluctuating based on your profit or loss. So if you're negative in a certain trade, then your equity will be less than your balance in the terminal, if you look at the terminal. And if you are up in a certain trade, you are in profits, then the equity will be higher than the balance. But when you close your trades, then equity and balance should actually be the same. They should balance out. So when next time you look at a chart and you see equity variable numbers there, then that means it's just a sum of your balance plus the profit and loss. So that's all, guys, for today. I hope you enjoyed the video and you learned one or two. If there's a term that you've been hearing around and want us to talk about, kindly comment in the comment section so that we can do another video to explain more other terms that you're interested in knowing. Cheers.